Hello, folks. Dan Bird here with the Daily Scan. Today is November the 4th, Monday, the day before Election Day. So I hope everyone will go out and vote tomorrow. I want to quickly go through what the market looks like, and we're probably not going to do any scans today because this week's going to be very volatile. I don't really like to take positions going into something like the election or the Fed meeting on Wednesday. We'll take a look at what we have so far, but probably won't do any new ones. So first, let's take a look at the market bias. So what you'll notice right here on the right is it's continuing to go down. So it started about a week ago, made a little bit of an up move, and then just consistently going down. So that's 1, 2, 3, 4, 5 days. So 5 days ago, we've been dropping every day. We are currently in a caution mode for the total market index. And actually right on the home page now, there's a link there. So if you want to look at the chart for the VTI, which is the total market, you can see right there, that's the signal, the bear signal, the short-term signal right there, which is what gave us the caution mode. You can look at the long-term as well, which is still pretty bullish, actually. So until it goes below this 21-week moving average, the blue line right here, the long term is still in a pretty bullish stance. So that's good news. If we look at the market bias page, we get a better view of what this looks like. And you can see anything that's highlighted actually changed today. So it went from a bull to bear if it's in red, went from a bear to a bull if it's in green. And for each one of these, you can see right now the Russell Value Index, actually the Russell Growth Index just changed to a bear. That's right over here, IWF. So if you want to actually look at the chart, you can just click on that and see the chart. Right there is where it switched to the short-term bear signal right here. So that's how that works. But down here, you can see on the day over day, week over week, that changes to red if it's lower than yesterday and lower than a week ago. And all of these are red right now. So we had a little brief period where the long term was trying to make a run, but now that's pulled back as well. So short term, medium term, and long term are all in the red right now. So that means lower than yesterday and lower than a week ago. That's what's causing this to go down. And you can actually see the trends down here. So again, continuing to fall. This week is going to be very volatile. We'll see what happens tomorrow with the election. There's really no way to tell. I think I have been saying that I think it's probably going to get extended. So no matter who wins at the end of the day tomorrow, or who looks like they're winning, I think there are going to be lawsuits filed on either side or both sides, and I think it'll probably just get extended. Might be similar to 2000 with Bush Gore. So we'll see. Let's take a look at the total market here, all of the different indexes. So here's the S&P, the Dow. Everything was red today, but just barely. But you can see everything was moving down. The VIX, however, moved up slightly. It's still above 20, but it's continuing to stay above 20. So, and I think that volatility is primarily because of the election. We'll see what happens tomorrow. It'll probably be volatile tomorrow and probably Wednesday with the Fed meeting. We'll see if things start to settle out after that. If they do, that will be good. But if they don't, that will be something to be concerned about. Bonds also pull back slightly. The 30-year pulled back a little bit. The 20-year TLT actually went up some. So that's actually good news. The US dollar dropped a little bit as well. Commodities, gold, just kind of going sideways right now. Silver, same thing, just going sideways. They both had a pullback recently. Actually, gold miners actually gave a short-term down signal on the market bias. Natural gas looks like it's starting to perk up. Usually seasonality right around this time of year, natural gas starts to move higher. And then crypto with Bitcoin going lower as well. And I'll show you something, actually I'll show you now, something that I changed on the website on the homepage is the charts for each of these indexes. So Bitcoin right here. I put in the Fibonacci levels. Fibonacci is basically a numeric calculation, and this basically just calculates levels from the high right here. And you can see right here it had a failed breakout. We're going to talk about that in a second. From the high all the way back to the low, and what I'm using in this case is the October 23 low. It was at 26.5 and made it up to 73.6. Right now it's at 67.6. So this is kind of the area that's trading in. It's been in this uptrend right here in this channel. It's right at the bottom of the channel. So we'll see if it continues to move higher or if it stays in that channel. Same thing with the S&P. There are the Fibonacci levels. You can see it's broken down from this bearish wedge right here. So that normally means we will have a continuation to the downside. Does not mean it has to do that, but many times that will happen with a bearish wedge like this, sitting right on the 50-day moving average and sitting right on right above a support line and right above the cloud. So all of these things we have to keep an eye on the next few days, especially tomorrow and Wednesday. And then the NASDAQ, which actually has not made it back up to a new high. It had an even tighter bearish wedge, which broke down, sitting right on a major support line right now. So it needs to hold that. There's a minor one just below it, and then the Fibonacci level is at 19,120, which if it does continue to fall through these levels, most likely that's where it's going, somewhere around the 19,000 area, somewhere in that neighborhood. So I think that would be about from 20,600. That's about 6 or 7%. If it makes it down there, it's actually a healthy pullback if that happens. So those some of the changes that I made on some of those charts right there. Let's also take a look at the 10-minute chart, just for fun. 10-minute, this goes back 7 days. So you can see from last week, Thursday and Friday, kind of collapsed. And today it's continuing to trend lower. So it's continuing last week's trend, basically. Technology is pretty much flat, financials flat, discretionary, communication services, industrials down from the open, but pretty much flat for the week. Those are the aggressive sectors. If we look at the defensive sectors, healthcare actually had a nice run last week, but it's pretty much flat now. Staples is flat. Everything's pretty flat right now. It's like everything's waiting for the election to happen. Utilities is the one sector that has been starting to really roll over and start to move down. So utilities actually had been leading the market earlier. And we can take a look at the overall chart and you'll see right here, you know, it's been in this channel and it made it to the top of the channel and now it's broken through and it's basically racing to the bottom of the channel right now. So we'll have to see if it can hold right there. And if not, then utilities might continue down here to the 200. This is a daily chart, so down to the 200 moving average for daily. The way that I like to look at sectors, actually, we'll go back and look at the dashboard again. The sectors are over here, but I want to show you a different way of looking at those. It's basically going to look the same, except it includes the S&P, so we can see which ones are outperforming. The industry groups over here is a kind of a mixture. Renewable energies, once again, is leading. So it is the technology sector, but it's renewable energies primarily leading. Energy has 3 of them in the top 10. This is staples. And then we've got this. So most of these, except for renewable energy, are defensive sectors. Discretionary is an aggressive sector. Real estate is defensive. Materials, usually defensive. And then we've got 2 at the bottom that are discretionary. So again, it's a mixture of the 2. And then on the right are the top 10 combined. This is my list that I typically use when I do the daily scan. And you can see Lumen is right there at the top. Why don't you take a look at that chart? Because this one has been consistently in the top 10. And I pointed this out Friday that it is just beginning to move out of that sideways channel. Now, earnings are coming up on the 5th, which is tomorrow. So it's anticipating good earnings, and it's had good earnings in the past. And with a sideways channel like this, in fact, this is basically a Darvas box. If I draw a rectangle around this whole section right here, for those that have studied Darvis, Nicholas Darvis, a ballroom dancing from the 50s that taught himself how to trade stocks and made millions. That is what he used. That's a Darvis box. He would wait until it trades out of the top of the box. So with earnings tomorrow, that might actually happen. So that's where he would place his orders when it trades out through the top of the box. And he noticed that strong stocks typically make these same patterns. They'll move up, they'll go sideways for some period of time, they'll go through the top, and they'll go up and move sideways again. And every time they go out of the box, that's when he would buy. So this is a classic Darvis box. I'm going to show you another one on the Magnificent Seven here in a second. So that looks pretty interesting. Again, right here on my dashboard. On my dashboard right here. These are the top 10. These all of these stocks have made top 10 lists over the last few weeks. Sherwin-Williams is on here right now, and it was just announced it will be getting added to the S&P. No, I'm sorry, added to the Dow. So it had a big day today with that announcement. Now, interestingly, the other one that will be added to the Dow, taking the place of Intel, is NVIDIA. So NVIDIA didn't really move much on that news. I'm going to look at that here in a second as well. But NVIDIA is the other one that will be added to the Dow. I can't remember the date that it's going to be added, but both of those, Sherwin-Williams had a positive reaction. NVIDIA had basically no reaction. So the next thing I want to do, let me show you the sectors like I mentioned before. Here are all the sectors, the same. This is intraday, or we can look at it at end of day. It's the same thing. So the same sectors, except now I've added in the Russell, I've added in the S&P, and primarily we want to look at the S&P. So even though these two are negative, they've outperformed the S&P. So that's the way I like to look at the sectors by including the S&P. It's not just which ones are positive or negative, but it's which ones are outperforming. And then I can go back and look at the whole week, 1 week, and again down here, the S&P. You've got communications, you got discretionary. It's a mixture of aggressive and defensive sectors. And technology is down here, underperforming the S&P. We can go all the way back. We can do back 3 months. I won't go much further than that. Almost everything was green except for healthcare, but the ones that were outperforming is the NASDAQ 100, communications, industrials, technology, financials, and discretionary. Most of these are aggressive sectors. So over the last 3 months, aggressive has been leading the market. All right, so let's now take a look at the Magnificent Seven. And I want to point something out that's very interesting. I'm going to use the zoom in feature here on the trend models. The trend models show you the short-term, medium-term, and long-term trends and the date that they changed. And if they're highlighted, that means they changed today, or this week rather. So 2 of them actually changed this week to negative for the medium term. But I want to look at the zoom in. The zoom out shows you a long-term weekly view. So if I click on that, you can see for Google, this is a long-term view. It had a pullback here and then started to take off again. But I'm going to use the zoom in, the shorter term view. And what I want to point out is notice this dashed blue line. So this basically had been resistance. This is Google. Google broke through resistance, had a great run after earnings, and we talked about this last week. If you look at it this way, it had a black candle. Black candles are not necessarily bad, but you want to watch them for the next couple of days to see if they will reverse and start to move higher. What you don't want to see is basically what this has done, which is close the gap and continuing to sell off. So that is not a good look for Google. And in fact, if I go back, yeah, there's Google right there. So even though it broke out of the downtrend line, it's starting to pull back again. So let's just walk through each one of these and you'll notice something that's similar. So here's the high, Amazon there. Amazon had earnings, hit the high and failed. So it's a failed breakout. The next one is Apple, same thing. High there, failed breakout. And now it has a short-term down signal. Meta, same thing, failed breakout, there and there. Microsoft, failed breakout there and there. It's starting to head lower. Actually gave the short-term down signal way back here. Next one is NVIDIA. Now, NVIDIA also actually broke through its previous high, but could not hold it. So it perhaps may have a failed breakout as well. It's really not broken yet. The chart, even though there's a short-term down signal, it's still above its 21-day moving average, and it's above all of its key support levels. So even though it didn't break out right here, it could actually be forming a cup and handle pattern. So that could actually be really good. And we're coming up on earnings on the 20th. So that might be what that's waiting for. We'll see. If it breaks through this top right here with a cup and handle, that's a typical IBD pattern that IBD likes to look for. And that's a great place to buy. In fact, there are probably lots of people that have buy orders just above that if it does break through. At Tesla, again, could not break out. So failed breakout on Tesla. Netflix is, there's the Darvas box that I mentioned before. So now we have a Darvas box on Netflix. It broke out from this box. So that would be the buy. And then you just want to watch it as it moves sideways. And when it breaks out at the top of this box, you buy some more. So that Netflix looks pretty good in a Darvas box. AMD looks terrible. Again, this is not a failed breakout from the highs. This is just a failed breakout of the downtrend line. So even though it couldn't even make it back up to the downtrend line, and it's continuing to fall now. SMCI is just in terrible shape. Their auditors resigned. It's just nothing but bad news for SMCI. But there's the high right there. Tried to make a breakout there and failed as well. And then the auditor news came out right after that. So that's quite a coincidence. Here's Oracle, failed breakout. Still not broken chart. Oracle actually looks fairly decent, but it's a failed breakout. So we'll have to see if it can recover. Palantir. So this one's interesting because Palantir just reported after the close, and their high is right here at 45. And currently, apparently they had good earnings because they're up $5 and at 46.70 after hours. So they will have a breakout tomorrow if that holds. So the question then is, we'll have to see if they can hold the breakout, or will they have a black candle like Google did? So that's the thing to watch on Palantir. But apparently they had good earnings because they are up 12, almost 13% after hours on Palantir. Arista Networks came down to the 21. This is actually healthy and looks like it might perhaps try to make another run, but it has not made it through its resistance level. Here's another example of a failed breakout. So Broadcom tried to briefly break through, but failed and starting to come down. And Eli Lilly, of course, same thing. Had a double top right here and started coming down, and now it's just completely falling apart below the 200-day moving average even. So my analysis or comment on that is, when you're when the market is in a volatile phase right now. Now, normally between now and January is the cyclically best part of the market, but it is in a phase right now where there's a lot of volatility and a lot of uncertainty, and all of that uncertainty could get resolved in the next week or so, but it could get resolved in a negative way. So we just don't know. For that reason, I am not taking any positions right now. I'm just simply managing the ones that we have. And the ones that we have are right here. Powell, which is still above our stop price right there, pulled back today, but still above the stop price. So we'll continue to watch that one. And then DocuSign, also still above the stop price, which is right at the 21-day moving average, but this one pulled back today as well. So we'll keep an eye on that, but both of those have pretty tight stops right now. We are not going to add any more, but we've got 3 of them that are currently on the watch list. Affirm actually looks pretty decent. It's hanging right in there at our projected buy price, but we're not buying it yet. We're going to wait for the market to settle down. Zeta, all these, by the way, have been on the top 10 lists consistently. So this is the kind of thing we like to see, just a steady move up. That's why it's been on the top 10 list. a pullback to the 65 and the top of the cloud. Looked like it was going to break out, and now it's pulling back again. So again, we're going to wait for that. This could come back and bounce there again and start taking off, but it's not ready to go just yet. And then the last one is Zim, which we identified last week. It had a nice move. It has earnings on the same day as NVIDIA. But again, this actually looks pretty healthy, looks pretty good, but finished at the bottom of its range today. If we look at the candle, you can see it's got actually two shooting star candles in a row. This is a shooting star right here, and you can see what happened. Now it has two shooting stars in a row. So again, we don't want to do anything just yet on this one, but we'll keep it on the watch list and continue to watch it. All right, so the last thing I want to talk about is I had a subscriber say, could I talk about vertical spreads, and in particular, debit spreads? And what I want to do is on the website, on the options page, there's lots of information about options for those that want to learn about them. There's time decay, so if you're a seller, you want to be in the short end down here, 0 to 45 days. If you're a buyer of options, you don't want the time decay. Time decay works for you if you're a seller, works against you if you're a buyer. So for a buyer, you want to have more time. So all of these things can explain all of that. But what I included, so I've got a vertical spread explained right here, credit spreads and debit spreads. Credit spread simply means, and I'll show you how we can do both of these. Credit spread simply means that you get a credit in your account, money goes into your account right away, and as long as the stock stays above or below your initial strike price, you just keep the premium. That's a selling strategy. A debit spread, on the other hand, is a buying strategy. So on the credit spread, you want a short term. On the debit spread, you want a longer term. And on the debit spread, then you have money taken out. You actually have to pay for the spread. However, it's a little bit of a more safe strategy. And all of this is explained over here in this book. You can click on this, Mean Reversion Trading. It's a great book. I highly recommend it for anybody that's interested. But what I created for spread strategies is this little cheat sheet right here that allows you to understand credit spreads and debit spreads. So I'll talk about the debit spread first. We're going to use the NASDAQ, and we are going to assume that it looks like the NASDAQ is going to be falling in the short term, just based on everything else we've seen. That doesn't mean it will, but it looks like it might be. So what we want to do is we want to do some bearish spreads. So the debit spread down here explains what it is. This is bearish. The way you would do it is you would buy a put at the money and you would sell a put lower. And I'll show you what that means. The strategy risk reward is limited loss, limited profit. The profit is because you only profit for the amount that it can move beyond the spread. Profitable conditions are a neutral market, a bearish market, or moderately bullish. And then the risk calculation, which is really important, the risk for a debit spread is simply the cost of the spread. So whatever it costs you to enter that spread, that's your risk. On the other hand, for a credit spread, which is a little bit different, for a credit spread, in this case, you would sell a call above resistance and you would buy a call higher. All right. But the risk calculation is the distance between the spreads less the credit that you receive. So sometimes credit spreads might look attractive, and it might look even more attractive if you have a big spread, a large distance between the buy and the call. However, it can significantly increase your risk if you do that. So I don't recommend you do that unless you're really, really sure. In fact, I don't recommend people doing options until they practice it, do paper trading, really understand it. Use this cheat sheet because it can really help. Make sure you don't make a mistake on creating your spreads, but that's the way to do it. All right, so let's actually do one. I'm going to use E-Trade. So I like E-Trade because it's very simple to use. It's easy to understand. So first we will do, and here's NASDAQ. These are the calls and the puts on here. So first we're going to do a debit spread. So remember, for a debit spread, it is a buy strategy. We think the market is going down. So I want to buy at the money and I want to sell lower. So, and I also want to move out further. So I want to go out, in this case, to December. The December expiration is 46 days away. If you can, give yourself the gift of time. That's a comment that John Carter always uses. Give yourself the gift of time when you're buying options. When you're selling options, make it shorter. When you're buying options, make it longer. So what I want to do is, as my cheat sheet says, I want to buy at the money and sell lower. So in this case, I'm buying a put. So I want to buy a put. Right now it's at 19,963. So I want to buy a put at, let's make it 19,975. So we'll buy a put there. And then we will sell a put lower. So lower would be this one. I can go further than that, but let's just take one. This is 25. This is a 25-point spread right there between 950 and 975. So if I sell that one, that is my spread. And what E-Trade does is it tells you right at the bottom, it shows you how much loss you'll take and what your profit will be. And that's the debit. So that's the amount that will be taken from your account. And that is your maximum loss, 965. So that's all you can lose on this particular trade. You can make as much as 1535. I like to set my goal of roughly 50 to 70% profit, and then I just get out rather than waiting for much more. But that's the way to do it. So we're in NASDAQ. This is one, so it's 100 shares. I can now preview this, and there's what it looks like. So it's showing me right there, $966 will be taken from my account. And when I send this in, okay, so the order sent. So that is sitting there now and ready to execute tomorrow. So that is a debit spread. So keep in mind now, if you're doing a stock, a lot of times the spread is only 50 points. So, and sometimes even less than that. So your risk can be very low. In fact, the minimum risk, the thing that the book says that I showed you before, says you can do a debit spread with one contract, your risk is only $250. And you could potentially make 70%. So if you do that enough times, that's where you start making some serious money. And what you can do, because you're going out 46 days with the debit spread, you can look for, these are actually daily options because the NASDAQ 100 NDX allows you to do it daily. So you can do 0 days to entry, 0 days to expiration rather. But you can do one every week if you want to. Even though you're going out 46 days, you could potentially do one every week. So let's look at the other side. Let's look at the credit spread. Again, we think the market's going down. In this case, a bear spread means we want to sell a call rather than a put. Rather than buying a put, we're now going to sell a call. So since we are a seller, we want to be on the short end of the expiration. So we sell above resistance and we buy higher. So resistance right now, we'd want to look at it, look at the chart to see resistance, but let's take 20,000 as resistance. So we want to sell at 20,000. So what that means is we do not want the NASDAQ 100 to go above 20,000. We want it to stay below 20,000 between now and the end of the day tomorrow. So this is a 0 days to expiration. All right, so that's tomorrow's expiration. And then it says we want to sell one at resistance and we want to buy a call higher. So if we buy higher, that would be this one right here. So 20,000, this one's 2010. So that's a 10-point spread. Now what you can see down here is it shows me the credit. This again is one contract, so 100 shares. It shows me right there what my credit will be. In this case, I'll have $515 put into my account. As long as the NASDAQ, the NDX stays below 20,000 by the end of the day tomorrow, I will just keep that $500. So that's how it works. So this is a credit spread. However, the risk on this, it says here maximum loss is 485, but the risk is, and that probably is correct, 485, but you can calculate the risk by the spread. So there's 10 points there times the number of shares. Only one contract, so that's 100. So 10 times 100 is $1,000 minus the 515 that you're getting as a credit. So your maximum loss is 485 in this case. Now, hopefully you can see that if you try to go further than just 10, you could go 100 points and you would make a lot more money. You could say, wow, I can make a lot of money in just one day if I'm right on my credit, if I go 100 points. But the risk then is 100 times 100, $10,000 minus the $5,000 you would receive in credit. So in that case, your risk is $5,000 instead of only 485 in this case. So for this example, I'm just going to do that spread, 10-point spread. All right, again, we'll do a preview and we'll send this order in. So this order is now sitting there ready to go for tomorrow. And we'll check in again tomorrow night and see what happened. We can look at the orders in E-Trade, and you can see there's two of them queued. One's a sell, one's a buy. So the buy is the debit spread, the sell is the credit spread, and then we'll see. So the debit spread is going to take longer. You know, we may be in that one for a couple of weeks or more. The expiration is 45 days out, but usually you don't want to wait all the way to the end. So probably would stay in a debit spread for about 30 days or 50 to 70% profit, whichever comes first, and then just get out. Now, I also would not take more than a 50% loss on this. So if you remember, it said the loss, I can't remember what it said for the loss, but I wouldn't wait that long. If it starts becoming a losing trade, I would just get out, basically. So that's the way that works. So anyway, that's it for tonight. Hope everyone enjoyed the session. Let me know in the comments below if there's anything you would like me to cover. I do have subscribers that have sent in suggestions, so try to accommodate that if I can. And good luck tomorrow for the election. Please go out and vote, regardless of who your preferred candidate is. Everyone should vote. And we'll see what happens. And then the Fed meeting on Wednesday should be very interesting. I expect them to cut by a 1/4 point. So we'll see if they do. All right. Thanks a lot, folks. And I will talk to you later.